Today, we are tearing into an analytical report that is basically shouting from the rooftops about a huge move in a key energy player, Energy Fuels Inc., ticker UUU. I mean, the title of this analysis alone is what grabbed us. It says, "Don't miss this move. Energy Fuels surges 6%, next stop $28.
Yeah, that's a seriously aggressive forecast, almost 50% above where it's trading now.
Exactly. But when you look at the chart, the analysts are making a case that it's completely warranted. You just woke up in a big way. It surged over 6% in just one session, closed strong at $19.26.
And on heavy volume, which is key. The report is calling it a massive breakout from a long consolidation phase.
Okay, let's unpack this.
We have to. I mean, a title that aggressive really demands a rigorous deep dive. When you see a stock with such a strong fundamental story suddenly make a technical move that decisive, you have to ask why now.
Right, what's the trigger?
Exactly. So our mission today is to really dissect this report for you. We're going to go way beyond the headline price. We need to separate the immediate technicals from the real foundational drivers.
The company's assets, its strategy.
Precisely. And we're going to analyze the actual roadmap the report lays out to get to that $28 target. We'll explore not just the what, but the why of this bet and, of course, the risks.
So let's start with that immediate action. The report called the move, textbook bullish behavior. This wasn't some slow drift up.
No, not at all. It was a fascinating session to watch, really. We've got the specifics right here, and they really tell a story of big money stepping in.
So what happened on the day?
Well, the stock opened at $18.32, which was already strong. But right after the open, it took a little dip down to $17.75.
And a lot of newer investors would see that and panic, right? They'd think, oh, it's a fake out and sell.
That's the whole point, and that's exactly why the analysts call this a move to flush out weak hands. It tests that immediate support, it shakes out anyone who's just barely in the position, and it forces the nervous money out. Once you shed those sellers, you establish a much more solid base of support.
So it clears the decks, gets rid of the jittery investors, and then the real buyers showed up.
That's the key takeaway. After it found that base around $17.75, the buyers just stepped in aggressively. The stock ripped higher.
Wow.
It hit a daily high of $19.80 before it settled back just a bit to close at $19.26. That 6.06% gain on that kind of volume shows real conviction. It's not just noise, it's confirmation that big money is buying this breakout.
And what does this sudden jolt really mean in the context of the last year? Because this hasn't been a quiet stock.
No, it's been volatile. And that context is so crucial for you to keep in mind. We're talking about a stock whose 52-week low was around $3.20.
That is a massive recovery.
A tremendous sustained recovery. It's built this huge foundation of strength over the last year, and now it's trading right at the upper end of its recent range.
So what's the next hurdle?
The immediate technical hurdle, the one stressed in the analysis, is that $20 psychological resistance point.
$20. It always seems to be a big mental barrier.
It really is. It's more than just a number. It's a ceiling in the market's mind. So if the stock can manage a clean close above $20 and turn that resistance into support, the analysts agree. The door just opens wide for a much bigger move up toward that $28 target.
Okay, that brings us to the fundamentals. The chart is the how, but we need to know the why. A pattern on a chart doesn't mean anything if the business is, brittle. And here's where it gets really interesting.
This is the real meat of the bull case. The analysts are so interested in Energy Fuels for basically three connected reasons, and they all speak to major national priorities.
Which are?
Energy independence and securing critical materials supply chains.
Let's start with the core business then, uranium. The report calls their position unparalleled strategic dominance. That's a strong phrase.
It is, but it's accurate. Unparalleled is the key word. So UUU is the USA's largest producer of uranium. That alone is a strong position.
Sure, but the true strategic value, the thing that puts them in a different league, is a single, irreplaceable asset. They own the White Mesa Mill in Utah.
And why is one mill so important?
Because it is the only conventional uranium mill operating in the entire country.
Wait, the only one?
The only one. Just think about that for a second. If the U.S. government or any big utility decides to really get serious about domestic nuclear power, which is a huge policy push right now, all roads lead to Energy Fuels. They are the essential bottleneck in the system.
So they don't just dig uranium out of the ground. They control the only domestic facility that can process it into usable fuel. That's geopolitical leverage, not just market share.
Absolutely. It puts a massive geopolitical risk premium on their stock. In a world where supply chains are, let's face it, fracturing, owning the processing is often way more valuable than owning the raw material itself. They are the one necessary domestic cog in the whole nuclear fuel machine.
That alone seems like a pretty compelling case. But the analysis points to what it calls the hidden value, a diversification strategy. Right, and that's the rare earth element play, the RE push. It's a brilliant move because it leverages their existing infrastructure.
A White Mesa Mill.
The White Mesa Mill, they're using it to process different materials. So Energy Fuels is aggressively expanding into REEs, which are, vital for the magnets in EVs, wind turbines, all kinds of advanced tech.
So with this one strategy, they're sitting at the crossroads of the nuclear energy boom and the green tech revolution.
They're essentially double dipping in two of the most critical materials for the 21st century, and it's all leveraging a single domestic asset.
And by being a domestic source for rare earths, they're helping the U.S. cut its reliance on foreign suppliers.
Exactly, primarily from Asia. So this diversification, it massively broadens their revenue potential and it hedges them against any volatility in the uranium market. This dual position is really the foundation for that aggressive forecast.
In holding all this expansion together, the analysis highlights their financial position, which seems incredibly strong.
This is maybe the most stabilizing factor in the whole picture. It's why analysts are comfortable betting on them long term. They have what the report calls a fortress balance sheet.
A fortress.
Yeah. I mean, we're in a high interest rate world where debt can just kill a company's growth plans. Energy Fuels has zero debt. None.
Zero debt and over $90 million in cash. For a company in a capital-heavy industry like mining, that is a serious war chest.
It's the ultimate insurance policy. It means they can fund all this aggressive growth ramping up mines, scaling their rare earth processing without getting crushed by interest payments. They don't have to answer to banks. That resilience is absolutely key when you're betting on a long game.
Okay, now for the reality check. Section 3 of the analysis really brings us back down to earth. We've talked about strategic dominance, all this cash, but here's the big question. Is the company profitable today?
And that is the essential pivot point of this whole investment thesis. The simple answer is no, not today. The analysis gives us the numbers. Revenue is growing fast. It's around $78 million, which is great. But the bottom line is a net loss.
And that feels like a huge contradiction.
Yeah.
Why would analysts be so bullish on a path to $28 if the company is losing money right now?
It's only a contradiction if you're buying a stock based on last quarter's earnings. This is a crucial distinction. The reason they're losing money is directly tied to why they're so strong.
How so?
They're not losing money because the business is failing. They're losing money because they are, and this is a quote, spending heavily to ramp up production.
So they're investing that cash reserve.
Exactly. They're pouring that $90 million into two main things. First, upgrading the White Mesa Mill to handle all the different rare earth materials. That's a big upfront cost. And second, they're bringing several of their uranium mines back online to capitalize on high prices.
So these investments are hurting current earnings, but they're building the capacity for future profits.
That's the core thesis of the report. The market is not buying current earnings per share or EPS. Investors are buying the future cash flow from these tangible, irreplaceable strategic assets.
It's a massive bet on future execution then. You're betting that all this spending today turns their strong revenue into massive profit in late 2026.
Precisely. You're playing the long game. The report argues that the scarcity of their assets, that domestic milling monopoly and the domestic RE capacity, it justifies the patience and it justifies this huge potential jump in valuation.
Which brings us to the roadmap. The analysis gives us specific technical targets that have to be hit to prove this $28 forecast is on track. What are those steps?
It's a pretty logical step-by-step path. It started with that breakout above $19. From here, the analysts identify two key price hurdles.
Okay.
First, as we discussed, they have to secure that $20 psychological level. They need to see a clean close above $20 for a few sessions. That confirms the buyers are for real and that the old ceiling is the new floor.
And once $20 is locked into support, what's next?
The chart clears up significantly. The next major resistance level that the analysis points to is the previous high, which sits around $27.33.
So that's right at the doorstep of the target.
Right. If momentum carries the stock through $20, breaking that old high puts the 28.8 target clearly and immediately in view. So those are the price levels you, as the listener, really need to watch to see if this is playing out.
So those are the technical triggers. What about a fundamental catalyst? Is there an event that could really pour gas on this fire and turn $28 from a ceiling into a floor?
Yes. And this is maybe the most fascinating part of the entire report because the critical catalyst isn't tied to their core uranium business.
Oh, interesting.
Investors need to be laser focused on the next earnings report. It's expected in late February.
The market's waiting for proof. Proof that the strategy is working.
Exactly. The analysis states that the true trigger for blowing past $28 is tied to performance in their secondary business. They need to show that this heavy investment is starting to pay off.
In the rare earth elements.
Yes. If that late February report shows improved margins on their rare earth processing, the report suggests that $28 isn't just a target anymore, it could be a floor.
Wow.
It means the market sees the successful scaling of the REE business as the key swing factor that could completely re-rate the entire stock. It would move it into a whole new category of critical materials provider.
That's a profound point. Uranium is the foundation,
Yeah.
but the rare earths are the rocket fuel for that $28 plus valuation. So what does this all mean? Let's try to sum this all up for the listener.
I think we can say the analysis concludes that Energy Fuels is positioned as, quote, arguably the highest quality, most strategic uranium play in the U.S. market right now.
Right.
You've got the domestic processing monopoly, a zero-debt balance sheet, and they're diversifying into another critical market at the same time.
But let's circle back to the risk. It's a volatile stock. It's already had a huge run-up. And as we said, they're losing money today.
And the analysis doesn't shy away from that. The volatility and the current net loss are the big headwinds. But it matches that risk with the high reward potential in the forecast. The whole thesis really hinges on their ability to execute over the next couple of years.
To turn those assets and that revenue into actual profit by late 2026.
Right. The technical move is happening now, which confirms momentum, but the fundamental payoff is still a 2-year story.
And as you track this company, especially heading into that critical February earnings report, there is one final provocative thought from the analysis you should really mull over.
The report really emphasizes that the main catalyst for pushing this stock past $28 is tied to improved margins in their rare earth processing, not just higher uranium prices.
Which raises a fascinating question for you to explore as you follow Yuri's story.
What does it suggest about the company's long-term identity and its risk profile if the ultimate success of this premier uranium play is now dependent on the execution and profitability of its newer, less mature rare earth business?
Is this secretly a rare earth company just wearing a uranium coat? That's the balance of the business you need to be tracking when that next report drops.